Alberta is still one of the best multifamily markets in Canada. That hasn't changed. What has changed is how forgiving the market is. In 2026, deals don't usually fail with a crash. They fail quietly through small assumptions that no longer hold up. Today, I want to walk you through what's actually breaking deals right now and how disciplined investors are avoiding those mistakes. If you're new here, I'm Darren from DK Wealth and Growth. And if you've been following along, you already know this channel isn't about hype or shortcuts. It's about helping investors think clearly, protect capital, and scale responsibly in changing markets. This is one of those conversations that matters before you buy, not after. The first mistake I see is assuming rent growth will save the deal. From 2021 to 2023, rent growth covered a lot of bad underwriting. That era is over. In 2026, rent growth has flattened at the top end. Lease-ups still happen, but they take longer and tenants are more selective. If a deal only works because rents might rise later, that's not a strategy. That's a gamble. Today, strong deals work on current rents, not future hopes. The second issue is underestimating CMHC-eligible financing costs. CMHC premiums increased in 2025. Higher leverage now comes with higher upfront cost. Leverage isn't free, it's priced. When investors ignore that, DSCR gets quietly squeezed. Cash flow looks fine on paper, but reality shows up fast. The best investors today model conservatively and treat financing as part of the risk, not a loophole. Another common mistake is relying on old CMHC strategies. I still see investors assuming approvals are automatic or designing deals first and trying to fix CMHC eligibility later. That doesn't work anymore. The program evolved. Underwriting tightened. Judgment matters more. What worked before doesn't automatically work now. Next is treating pro formas like guarantees. A pro forma is a scenario, not an outcome. In a balanced market, aggressive assumptions don't get hidden. They get exposed. That's why stress testing matters more than upside projections in 2026. Strong deals can absorb pressure. Fragile ones can't. And finally, skipping real due diligence, builder quality, unit mix realism, design efficiency, exit assumptions. Most bad deals don't blow up. They bleed slowly. The danger isn't obvious, it's quiet. Here's the payoff. Alberta still works. CMHC-eligible multifamily still works. But 2026 rewards discipline, not optimism. The investors who win aren't chasing perfection. They're avoiding mistakes. And if this way of thinking resonates, if you're focused on protecting capital and scaling responsibly, there's a link below where you can learn more about how I work with investors and whether a conversation makes sense. See you next week.